Welcome to The Explainer. Today, we're digging into the Q2 2025 earnings call for Twin Hospitality Group. And wow, what a story this is. We're talking about some serious market whiplash and a company that's trying to pull off a big turnaround right before our eyes.
All right, let's just jump straight into the drama here, because it's a wild one. Right after their earnings call on July 30th, the stock shoots up 6.5% in after hours. Looks great, right? Well, hold on. By the time the market closed the very next day, it had cratered, down over 21%. I mean, that is a textbook head fake that just vaporized all that initial excitement.
And believe me, this was not a quiet little drop. The trading volume absolutely exploded to over 108,000 shares. To put that in perspective, that's more than 7 times what it normally trades. So what does that tell you? It tells you that investors heard the big picture strategy on the call and thought, okay, I like this. But then they slept on it, they dug into the numbers, and they got seriously spooked.
So you gotta ask, what on earth caused this crazy roller coaster ride? That's exactly what we're gonna unpack. We'll start by decoding those Q2 results, then we'll look at the new CEO's playbook. After that, we'll dive into the pressure on their balance sheet, and finally, we'll wrap it all up with our take, the next call, and our official rating.
All right, let's get into it. First up, decoding those Q2 results. Let's look at the numbers behind the narrative. Okay, so the headline numbers, they're not pretty. They posted a loss of 38 cents a share. Revenues slid backwards by over 4%. And maybe most importantly, adjusted EBITDA, which is really a good proxy for their core profitability, that fell off a cliff, down almost 26%. So you can see right away the tough spot management is in.
And right here, this chart is the whole story. This is the core of the problem, but it's also the key to the entire turnaround plan. Just look at that huge gap in profitability. The main brand, Twin Peaks, is doing great, a really healthy 17.7% margin. But then you have Smokey Bones, struggling to even break even at under 5%. Seriously, this one visual explains almost every decision they're about to make.
And to make things just a little bit worse, even their star player, Twin Peaks, stumbled. Same-store sales actually dropped 4.4%. Now, what did management say? They pointed the finger at a less favorable sports calendar. You know, they talked about the Dallas Mavericks not making the playoffs, some international soccer games happening at weird times. That was their explanation for the dip.
So, you have this really tough situation. What's the plan? Let's check out the playbook from the new CEO Kim Boerema and see how he plans to fix this.
He laid out a 6-point plan, and it's really all about getting back to basics. We're talking focus on fundamentals, reduce complexity, sharpen cost discipline, streamline the menu, be smarter with pricing, and then you can position for growth. It's a classic operational turnaround strategy.
Now, the absolute centerpiece of this whole thing is a concept they're calling asset remixing. And the idea is actually pretty straightforward. You take the underperforming, low-margin Smokey Bones restaurants, and you either close them or, better yet, convert them into the high-margin Twin Peaks lodges. It's all about doubling down on what works and getting rid of what doesn't.
And they are not wasting any time putting this plan into motion. Look at this timeline. They've got a franchise conversion opening by the end of this year. 2 more company-owned ones are slated for early 2026. And the big goal? To have most of the 30 planned conversions either finished or well underway within the next 12 months. They are moving fast.
Okay, but a great strategy is one thing. Executing it is another. And this plan is basically a race against the clock, which brings us to the immense pressure on their balance sheet. This is the execution gauntlet.
Okay, here it is. This is the number that almost certainly sent investors running for the hills and caused that 21% crash. $11.5 million. That's not revenue, that's not profit, that's just their interest expense for 1 quarter. That is an enormous amount of cash just flying out the door, and it means they have absolutely zero room for error. They have to get this turnaround right, and they have to get it right now.
So how do you fight that kind of debt pressure? Well, you raise cash. The plan is to raise somewhere between $75 and $100 million in new equity. Now, that plan got delayed a bit, but you can see the CFO here, Ken Kulik, making it very clear they're still confident they can pull it off in the next year. And let me tell you, they have to. Getting that cash in to pay down debt is non-negotiable.
So when you put it all together, you see the path forward as well? It's pretty narrow. They're bleeding cash from operations, they have high overhead costs, they have these huge cash demands for both the debt and the conversions themselves, and all of this is happening in a pretty strong consumer environment, so any stumbles are going to look even worse.
The execution risk here is just sky high.
Okay, so after all that, where do we land? It's time to put the bull case and the bear case together and make the call. You've got the ambitious turnaround plan on one side and these massive financial headwinds on the other. So, what's the verdict?
We're coming out with a market perform rating.
So here's our thinking behind that. The bull case is simple and logical. This conversion strategy makes a ton of sense, and if they pull it off, it could unlock a lot of value. But the bear case is just as powerful. That giant interest payment creates a huge liquidity risk that you just can't ignore. So right now, the risk and the reward feel pretty balanced. This is the definition of a show-me story. We need to see proof.
Now, with a show-me story like this, how do you trade it? Let's talk about our trade idea.
We're suggesting a long straddle. Now, what that means is you buy both a call option and a put option. You're not betting on which way the stock will go. You're betting that it's going to make a big move, one way or the other. It feels unlikely to just tread water. Think about it. If they start nailing these conversions, the stock could seriously rally. But if they miss a step or fail to raise that cash, it could collapse further. This is a pure bet on volatility because we think the outcome here is going to be dramatic, not quiet.
And of course, a reminder, this is not financial advice.